Thanks everyone for coming to today's presentation on the royal tax. Unfortunately, Megan won't be able to be here today, so you're stuck with just me kind of hosting, presenting, and answering questions. So hopefully it goes smooth. One of the things we're going to cover today is cost segregation studies and kind of give you a rundown of what it is, how they kind of happen, and then the benefits to them. And then after that presentation, we'll open it up to maybe if anyone on this call has done a cost segregation study, they could share their experience. And then from there, we'll just kind of field questions regarding the cost segregation and any other pressing topics before the tax deadline. And that's what I'd like to discuss in the breakout rooms today. When you're in your groups, if you guys want to come up or decide any ideas on what you're most worried about for this upcoming tax deadline of 4/15, or if you're going to have an extension, what are you worried about on that? Or if you guys aren't worried about any items coming up for this tax deadline, just kind of discuss what's going on and sharing your knowledge with the other members in the group. All right, as mentioned earlier and kind of talked about, and I'm sure we'll have some good conversation afterward, is I just threw a couple slides together for cost segregation. Ken, if you'll move to the next slide. What is cost segregation? Cost segregation is, in essence, a tax deferral strategy that front loads depreciation, and it allows you to take deductions of real estate assets in the earlier years of ownership. But what it does is it takes a property and it chunks it up by assets, and certain assets have lower tax years, 5, 7, 10, 15, and 27 and a half. So the study goes into an apartment complex, a house, a commercial building, and they will identify what assets can be classified in each depreciation year schedule and come up with a value. Usually this results in significant tax savings for individuals that do a cost segregation study. Ken, if you can go to the next slide. As I kind of touched on earlier, there is tax benefits to it. Really, it's deriving and identifying what the short life property is. So short life property in this example could be carpet. That's not a 27 and a half year asset. That could be a 5-year asset, a 7-year asset, or you can maybe get 100% bonus depreciation during the current year, depending on the tax law. Usually when you do reclassify assets into the short life property, you can get about a 10 to 40% of the depreciable basis moved up early in the years. So as Matt mentioned earlier, his first couple of years of doing the cost segregation, he had huge passive losses, which he could carry forward. So there are benefits to doing it. Again, really the main benefit is more depreciation in the front years, lowers your taxable income if you're a real estate professional, or it increases your passive losses that you can carry forward indefinitely or until you run them out. If you could go to the next slide, Ken. Just with everything, there is also pitfalls of a cost segregation study. One of the pitfalls is if you do a study and you sell it in a more near term than long term with, let's say, under 3 to 5 years, you could end up having to pay depreciation recapture, which could be a higher number if you sold it outright and didn't do a 1031 exchange, because you took more depreciation on the front end, your basis is lower. When you go to sell, you have a higher capital gain, and that could be taxed at your ordinary income tax rate, depending on when you do the sell or the cost segregation study. So you could actually end up paying more in taxes when you sell. Again, that can all be wiped away if you do 1031. Sometimes though, if you do the cost segregation, and kind of the consensus I saw online was you have to keep the property 3 to 5 years to really get your money out of it because of that depreciation recapture, but also the amount of money you paid to an engineer or a CPA or a company to do the cost segregation study. Usually 3 to 5 years, if you keep the property, you'll get your return on investment. in most instances. Now, there's always exceptions. If you did a warehouse, most likely that's going to be longer than 5 years to recoup because they're not going to have that many short-term assets in it as a house or apartment complex would. And then the biggest pitfall is if the taxing authority does not agree with how your cost segregation study was done. So what the IRS could say is the assets that you put as a 5-year asset or a 15-year asset, they could say, no, that's not correct. That's a 27.5-year asset. Or they could say it's a 15-year asset instead of a 5. So they may come in and you may end up having to owe taxes and then a little fine or percent on taxes not paid if the IRS disagrees with your study. So, but again, regardless of what we do, we're always subject to penalties by the IRS if they disagree with how we file. But that's just one of the potential pitfalls of a cost segregation study. All right, thanks, Ken, for moving the slide. The next slide talks us kind of about the process of how a cost segregation study works. So the first step is a feasibility analysis. So this is kind of where you reach out to your CPA or financial advisor, or you enter it in TurboTax and do it yourself if you're savvy with that. And you kind of see what your current tax position is and tax liabilities. And then you kind of enter in property characteristics in your head to come up with, oh, I bought this house for X amount. We'll assume 20% is a 5-year asset, 15% is a 20-year asset, and so forth. And then you can kind of run models and scenarios at a very high level to kind of see if the study is even worth going into the next step. So usually going to the feasibility analysis, a lot of that's just a free consult where you can talk and meet with someone to determine high level, yeah, I may save money doing this. Then the next step is where you've committed, and sometimes these are broken into 2 steps, but I have it here as one, and that's to gather and analyze. So it's pretty self-explanatory. You gather the information. So by gathering the information is you get the appraisal, you pay for an appraisal if you haven't had one for a while. You look at the purchasing documents. If it was a remodel, you can look at the general contractor. You can see what they paid for if you were replacing carpet or cabinets. You get the cost of the project that way and you start making notes. If you buy a new house, sometimes the general contractor or the builder, they can provide you a kind of a list of what each item costs, and then you can group it that way. Sometimes examining the property also helps, and that's where the engineer or the CPA or yourself can go examine the property, get the square footage, get the type of materials. Is it a wood floor, the cabinets? What type of cabinets are there? The tile? Are there extra lights installed? You kind of just take pretty much a detailed information of what is on the property. And then you start classifying those into different asset classes. And then what happens is once that is done by the person doing the cost segregation study, they'll provide you a report. And the report should be a pretty in-depth report that explains, here are the assets for 5 years, here are the assets for 7, 15, 27 and a half. They should explain on the report, hey, this is what their methodology was. It could be a fair market value. They may have a formula or an algorithm that they use to project what costs are based on previous cost segregation studies. A civil engineer can maybe go bid it out. They just need on the report, make sure they just explain how they did the methodology. And then in that report, they should also list the tax law and sections that support why they're putting each asset into that class. So what you want there in essence is that report to be very detailed. So if you do get audited and the IRS does just do a disagreement, you can show them that report and argue this is why it was done this way, because more likely than not, the cost segregation person who did the study won't be talking to the IRS for you. So you want kind of the report to have all the detail as possible. All right, Ken, could you go to the next slide? All right, thank you. So in the first examples, this is kind of the ordinary, I just bought a house for $175,000. That's the house structure portion, doesn't include the land. And if you were to take the normal 27 and a half year depreciation, you get $6,363.64 in depreciation expense for the year. So as you all know, you got your rent minus your profit, minus your repairs, maintenance, management fees, and so forth, and then you minus depreciation. Hopefully you're ending up with a negative number or at zero. And that's what this depreciation amount is in this example, which is your typical set amount for 27 and a half years, as long as you keep the property and don't do any substantial updates. Using the next slide, Ken, using the example two, it's the same house, same situation, but there was a cost segregation study done. And what this study said is there's building components, site improvements, and building structure. So the building components, according to the cost segregation study, is about 22,000 of that 175,000. And again, building components are cabinets, molding, flooring, wood or laminate, accent lighting, window treatments, appliances. If you do anything specialty, any specialty items for HVAC systems or electrical systems above the standard, those would fall into that building component. So this 22,000 would be divided by 5 years. Site improvements, those are 15-year assets, and those are kind of like sidewalks, driveways, exterior fencing, shrubbery, bushes, and those are a 15-year depreciation schedule. So this 7,500 would be depreciated by 15 years. And then everything else is in the building structure, which gets that typical 27 and a half years. So building structure, that's doors, framing, painting, roof, foundations, windows, kind of most of the house costs. So in this example, by doing a cost segregation study, they actually the first year have $10,218,000 in depreciation. So that went from about $6,300 to $10,000. So they almost increased their depreciation $4,000 the first year. So the first 5 years, you would have an extra $20,000 in depreciation. So the first 5 years, your passive losses would grow or be 20,000 higher over a 5-year period, which, depending on if you're a real estate professional or just a passive investor, that can affect your active income, or it can just keep carrying losses forward. But as you see, after 15 years, you'll just be using the building structure at 27 and a half years. So instead of having that 6,300, you'll probably be below, closer to that 4,000 a year. So that's where I think Matt was talking in his example is, as he gets later on in the life of the property, you do have less depreciation. But the goal is to keep adding property and growing your real estate empire to where cost segregation studies keep coming on and you end up not having less depreciation. Next slide, Ken. So really what you need to ask yourself is, do you need a cost segregation study? And again, the favorite answer I have to give, it depends. No one likes that answer, but it does depend on your situation. If you're going to get rid of the property within a year or two, might not be worth it, especially if it's a big commercial property, because there's a lot of cost depreciation that you might not be able to take. Depending on your tax strategy for the long term, if you want to carry passive losses forward for the long term and have it just be levelized and not have to worry about the swings, a cost segregation study might not be the way to go. If you are a real estate professional and you do have high active income, it might be better to do a cost segregation study, regardless of the time horizon of how long you plan to keep the property, because it lowers your taxable burden today, which gives you more money in your pocket that you can go invest and earn a return on. So that's where I kind of say it just depends on your tax strategy, if you're a real estate professional, and kind of the long-term outlook for that property or your portfolio of properties.
Hey, Pete, I might have misheard something, but if you could just clarify, you said if you have high active income, why not if you have high passive income?
It can also it can also deduct off passive income as well.
Yeah. Okay.
So most instances, people with the passive income are usually have losses because of the depreciation, so they don't have to have larger losses in passive income. But if you're retired and you do have really good properties that are performing high, you would probably want to take this then to create more of a loss to offset that passive income.
Right. I guess I'm speaking selfishly because I have very old properties where the basis is so low, there's just not a lot of, there's nothing to depreciate anymore.
Yeah, no, if the property is old and like you said, your basis is zero, there's no point in doing a cost segregation study. But those properties with low basis, you're probably making a good return on. So your newer properties, even though it's all passive income, you would probably want to do segregation to help lower your high performing older properties.
Or if you're remodeling that older stuff, then all of a sudden you've got more stuff to depreciate again.
Correct. And a remodel, depending on what you remodel, those usually could fall under the 5-year asset. Or depending on the tax year, you might be able to do the bonus depreciation at 100%. So
yeah,
depending on the asset. And avoid the whole cost segregation study at that point.